Hey, everybody. Welcome to the Multifamily Legacy Podcast. I'm your host, Corey Peterson, and I am so thankful that you're here today. As I'm recording this, it is September 11th, and I want to start this episode out by reading something that we just posted on Facebook that I truly believe represents America and truly who we should be. So I posted this, and this was a great quote by Martin Luther King Jr. is darkness cannot drive out darkness. Only light can do that. Hate cannot drive out hate. Only love can do that. Taking a couple of minutes to craft a never forget post because it's the thing to do, and then returning to an attitude of division and shouting at your fellow Americans shows that you've already forgotten. Many Americans have never felt a greater sense of unity to their fellow citizens than in the days following the attacks of September 11th, 2001. Despite differing opinions, religions, and skin colors, we stood as a country united by an unthinkable tragedy, and we rose up together as Americans. The only way to truly honor the thousands of lives lost on September 11th is to not talk about unity and remembrance, but be about it. We can honor these tragic deaths by being a productive and meaningful member of society. Not just today, but every day. You will be a better person for it, and we will be a better country because of it. Just want to take a minute to pause and let that sink in. Guys, I am so thankful that you're here. We live in the greatest country ever. We have so many opportunities to be successful and to do business and to work and toil and become anything that you set your mind to it. I truly believe it in my heart that if you set your mind to something and you believe in it with all your might, with all your passion, with everything that you are, you can be successful. So guys, a couple things going on in the Kahuna world. First of all, I am super excited to announce, this is a big announcement, okay? Woo, 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 woo. Big announcement. We are creating the Apartments to Millions Summit event coming in April 8th, 9th, and 10th. And I'm going to tell you right now, you are going to want to save the date for those 3 days, April 8th, 9th, and 10th in Phoenix. The Apartments to Millions Summit is where you're going to be able to find all your deals, all your money, all your partners. It is going to be the best multifamily networking event in 2021. I promise you, we do not do it crappy. We only do things first class, and this is going to be an award-winning networking event with great speakers, with great information, with great teaching, and honestly, and great people. I mean, investors with money, deals, syndicators, potential partners. Everything that you will need to do an apartment deal will be at this event. So I highly encourage you to save the date. We're not ready to market it yet. We just booked our hotel. We are getting ready to plan something truly Kahuna style, and it will be epic. That I promise you. And then lastly, listen, I love it when you guys take the time to go to iTunes and give me a 5-star review. Okay, you know I love them. So get out there and if this podcast is making a difference in your life, let us know, because it truly makes a difference in my attitude, my happiness. So I like to get excited about it. All right. So my next guest today is one we've had him on the show before, but I wanted to bring him back on the show because he really had a concept that we were talking about it, and it really made a lot of sense. And so our guest is Chris Miles. He's the anti-financial advisor. He teaches entrepreneurs and professionals how to get their money working for them. He's also an author. He's and a podcast host of the Chris Miles Money Show. And he's been featured in U.S. News, CNN. His company, Money Ripples, helps get his clients fast financial results. So in this episode, we're going to talk really about getting your money to pay you twice. Getting your money to pay you twice. It is a great concept. And so with that, let's welcome Chris to the show. Chris, welcome to the show, brother.
Hey, it's good to be on, Corey.
You know, before we started the show, you were really kind of telling me about the subject we want to talk about, and it's getting your money to pay you twice. And I would love to learn that trick. And I think a lot of people in the audience would love to learn how to get your money to pay you twice. So tell me more about that. How does that work?
You know, it's interesting because I thought every investor knew about this. So I thought, even when I would go to big mastermind groups, I'm like, you guys probably already know this stuff. And I was shocked to find out most real estate investors don't, or at least don't know how it really works, right? So, I mean, it's not too much of a mystery. You've heard people talk about infinite banking, whole life insurance, things like that, right? That's not the first time it's been pitched out there, but they've got a lot of these typical insurance agents that are out there, right? They're just pitching you crap. They're pitching you a product and they don't think from an investor perspective, right? They don't think how can this really work? And for me, honestly, I started out.
Yeah, I'm saying most insurance guys only think with what's in it for them.
Yeah, exactly.
How do I make more commission?
And they try to pitch it to you this is some long-term game, right? Hey, you keep putting money in this and eventually be able to retire. It's like, well, dude, I can buy real estate and retire way better than any product you could possibly offer me, right? And remember, I wasn't always that mentality. I started out as that traditional financial advisor almost 19 years ago. Did that for 4 years, realized nobody was retiring off of it. So I quit. And then that's when I met real estate investors who did do it. So I like to go with the evidence, right?
Yeah.
And it was actually from those real estate investors, they started talking about using whole life insurance. But it never made sense in my mind because I'm like, yeah, but it's like tug of war. It's competing with your dollars, right? Because they're trying to say, throw your money over here. But that means I'm not accelerating my money in real estate, And they were talking about after 10, 15 years, maybe you can use it. I'm like, well, that's screw that. I want money working now.
Yeah.
And over the years, I started to really get into it more and more. And I've been insurance licensed for that same period of time, right? But then I started to find a way to do it where you can minimize your cost of the insurance to where almost all your money goes to cash. And that money can be used to be redirected into your real estate. Now you think, okay, well, so what? It's just filtering money. It sounds like money laundering almost, right? It's not money laundering, but you're just filtering money through. But this is what I learned is that when I started to do that method versus just using my savings or checking account, I almost created this tax-free supercharged savings account. Because when I ran my money through there, what happens is that the money's still in there, right? Because let's take an example. Say you've got a couple $100,000 in there, right?
Yep.
If you had a couple $100,000 sitting in your savings,
a couple $100,000 sitting in our savings, is that what you're saying?
Yeah. If you have it sitting in your savings anyway, like a normal savings account, you pull $100,000 out to go and invest. Maybe you put into a syndication or a multifamily project, right?
Yep.
Well, now that $100,000 will not earn interest other than in the syndication. So your $100,000 your savings lost interest. Now, granted, your savings accounts, especially right now, are point nothing percent.
Yep.
But what happened is I realized wait, if I did the same thing with life insurance and minimize the cost to where I have just as much money as I put in or more than a savings account within a few years, and that money's still there growing, all of it. So when I use the money there, I'll end up borrowing from the insurance company that $100,000, right? So that $200,000 is still there earning tax-free, 5+% interest, right? But now I've got this other money out here that I borrow from the insurance company, like a line of credit with no payment, nothing like that. I can go and invest it. So therefore, I'm making money in the investment and my money's still earning compound interest inside this policy at the same time. And so just like I showed a guy yesterday, what ended up happening is that he said, well, Chris, it's not making sense because I'm borrowing. I have to pay interest to them. I'm like, you do. You pay interest to them. Don't believe all the insurance guys that say you pay interest to yourself. That's bullcrap. You actually do pay interest to an institution. You do pay to an insurance company, usually about 5%. He's like, but the numbers don't seem to make sense. I was like, well, the key is my money's compounding in here tax-free. Well, when I'm using the cash flow from the investment, the quarterly returns and things like that, that's paying down the loan. That actually means that the interest being charged goes down. Well, the interest I'm earning goes up. And so it creates this huge spread. It kind of goes like this, right? And so what ends up happening is I showed them, I said, here's the numbers after like so many years of, doing your real estate investment, paying it back in with your cash flow to build up your savings to reinvest again, right? Always cycling the money to keep reinvesting. Cool thing was he would have to earn, and he was in a low tax bracket, he'd have to earn 6.6% on his savings account to match what I was doing with my life insurance policy. The same thing that he would do for himself.
Right.
And that was like that epiphany that I had even a few years back is, wait a minute, this is huge. Like I was just trying to use my savings account, but if I can make money in two places at once where it adds, so say that, your syndication gets an IRR of 16, 17%, right?
Yep. 12, by the way,
cool.
for everybody listening, it's 12.
Yeah, or 12. Yeah. Well, we'll keep it conservative, right? Say it's 12%, right? Well, if you're making at least another 4% on top of it, it means you're getting a total of 16% of that money because it's making money in two places at the same time.
Yeah. Now that's very interesting. I've never seen that idea like that. So now, is this typically, what kind of policy is it? What kind of policy are you talking about?
Yeah, it's using whole life. But I like to refer to my method as more of like a max ROI Infinite Bank, right?
Right.
There's a lot of infinite bankers out there that talk about that.
I don't even know what infinite banking is either. So this is how far I've been out of this space. Yeah. But I'm really interested because I just have questions as me personally just asking them that probably listeners would have. So we take this money, we'll call it $100,000, right? Yeah. I'm going to go buy whole life insurance that has a cash value.
Yep.
Right. Now you're saying to try to get a cheap cost. Tell me what does that mean?
Yeah. So most whole life policies, the big criticism against them, right? And this is what I had against them too, is that in the first year, if you buy a normal whole life policy from an agent or even from an insurance company, right? That first year, all of your money goes to insurance costs, right? So whole life is almost the opposite of term insurance. You know how term insurance gets more expensive over time?
Yep.
Whole life is front loaded and then gets cheaper over time. And so you have this huge cost. So the first 2 years, and this was my first whole life policy I bought even from these guys that referred me, these real estate guys referred me to these insurance agents, right? My first whole life policy, I put in $25,000 over 2 years, and I had like zero cash in there, zero cash value, zero savings, because it all went to fees, which includes their commissions, by the way.
Oh yeah, that's why you sell whole life policies in the game, was to make big fees. Yeah. But they're not talking about the other piece, what you're going to talk about, like how to make it really work. This is really a wealth strategy that wealthy people truly use.
I'll tell you, most wealthy people aren't even doing it to this level, even this well, because again, they get referred to people that make big checks, right? Well, what I found is, and I was actually referring people to another insurance guy a few years back, and then an investor said, Chris, I need you to teach my people how to do this. He had his own podcast, he had his own investments and whatnot. And when I came out, kind of out of retirement, right? Because I was able to retire myself financially independent in 2016.
Yep.
So I didn't even need it. I was like working 5 hours a week doing my own podcast show, and things like that. And he's like, hey, I want you to teach my people. I'm like, dude, I don't want to go more than like 5 hours a week. If it stays about 5 hours a week or so, I'm good, right?
Yep.
Well, when I came out, I found out that even the guy I was referring to that I thought was the best in the industry wasn't doing as good as he could have. Yeah. Because I found out like when you tweak certain numbers, you can reduce costs. Okay. So instead of 100% going in the first year or two, right, to costs, the first year I can get the cost down to like 20%. So if you throw in $50,000 that first year, you have about $42,000 in there in cash that you can use and leverage. Instead of zero, you got 42,000, right? Right. You put in another 50,000. The next year, you got about another 45,000 going in. So now you're already up to like 86,000 plus instead of zero or $1,000. Right.
So that's the key to that, is to get the cash value up quickly. So then you take that money and borrow it. Yep. Right. And then go put that in an investment. Right. Yep. And then, so now you've got just the cash value policy doing its thing, making its own return. Usually, between 5 and 6 is usually what they're paying. Is that about right?
That's right.
Right. And then you can find another place where you could get 12 or something like that. Now, typically, how long can you get that loan for?
However long you want. So it's kind of like, it's like a Roth IRA, a savings account, and a HELOC all in one, right?
Okay. Yep.
The savings account, because it's very liquid, you can get to the cash within about a week if you need it, So it's not like a Roth IRA with all these, 59 and a half rules and all that kind of crap, right? Or you're not limited to 6,000 a year. The truth is you can actually put in up to 25% of your stated gross annual income per year.
So I got some questions. I want to make sure that I'm Art Williams, Primerica, buy term, invest the difference, right?
Yeah.
That was how I was indoctrinated into the business. So I'm gonna put that hat on a little bit because I just want to, in my mind, understand this because I understand what you're saying now, which is different than I've ever heard anybody talk about, right?
Yeah.
And I'm starting to I'm swimming around in it here for a minute. So I got this. I'm doing it more as an investment vehicle because I know. So as I grow my cash value, now eventually I die or something happens, right? Then what do we get?
Then you get the death benefit, whatever it is at that point, minus any loans you took out. So to answer your question about the loans, the due date, the balloon payment that's due is death.
Okay.
And they just they pay that out with the death benefit.
If you're always taking your money back out and then you die, that's what you have.
Yeah. Yeah. So for example, there's difference. The death benefit's always higher than the cash you have in there, right?
So hold on, I got another question.
Yeah.
Right. When I invest in, let's say I invest in a syndication like mine, right?
Yeah.
Am I investing as an individual or am I investing as as the insurance funds or something like that? So when I borrow money, I'm borrowing it as Corey Peterson.
Yeah, you do.
Okay, so my investment is paying Corey Peterson money in return, plus I'm making the death benefit as a return as well.
Right. So any depreciation tax benefits you pass on, you get like normal, just like if you paid out your checking or savings.
Okay. Now I'm following you. I totally get it. And what you're also saying too is because let's say you have your premiums that you pay every year, right?
Mm-hmm. Yeah.
Eventually, you're going to have enough. You keep growing the value, your cash value. Now you're investing that money. You're making enough returns to even cover the cost of your insurance.
Yeah.
Year over year, right? So
usually by the third year or so, you can cover the cost of your insurance already. Like you're basically net gaining in your policy.
Right. And then if you do die somewhere in between, your death benefits, then that's tax free.
Yeah. And the money growing in there is also tax free, just like a Roth. The only difference is the investment doesn't go inside the policy, right? Like your syndication is not like a self-directed IRA.
Exactly. That's the beauty of it.
Yeah. Yeah. Exactly. You don't lose
because that money is off the side. Like it's not even to do with anything about what's going on with the insurance.
Exactly. Yeah. It's perfect for real estate investing, especially. It can work for other things, even short-term stuff.
No, but that's still a good way to. I mean, you get the best of both worlds. I mean, so like as a rich person's, when you start thinking and working like wealthy people do, and I'm talking super wealthy, they do this at a whole different level, but it's the same concepts that wealthy people use to play the game and to transfer wealth as well. Yeah. Right. Transferring wealth is just as important from generation. Like let's call it the Heinz. It's not ketchup. I mean, it is ketchup, but Heinz Corporation, I'm thinking about even like name a cereal brand, Kellogg's, right? Yeah. The Kellogg's, like not the company, but like the people. They're all rich. The Waltons from Walmart. Yeah. They are playing the strategy to give people to pass on their generational wealth as well. Yeah. And make income at the same time. Yeah. Even banks. I remember during the Great Recession. I mean, there was banks like Wells Fargo, they had 23% of their assets, their liquid money, sitting in life insurance accounts like this, right? Wow. They were throwing their money in here to keep it safe because, when we were watching all the interest rates drop like a rock lately, my policy still, pays like what it's been paying. It's still, most companies are still paying between 5 and 6% a year tax-free, By the way, we compare that to the stock market. The stock market only returns after you've paid all your fees and everything else, right? Maybe, about 6.5% or so, even if you're in the S&P 500. That's the average for the last 30 years when you factor in fees. That's not counting when you take out taxes, right? Right.
This is tax free. So this is almost like earning 7-8% a year, not 6.5%. You could even exceed the stock market potentially, and not have to worry about all the market risk, all the bipolar nature, because Trump sneezes a tweet on Twitter, and the market loses.
And the market goes responds good or bad or ugly or whatever it is, right?
Yeah. That's if you do nothing with it. But when you invest with it, that's the whole game changer. That's when you start creating acceleration of money and wealth.
Yeah. No, I've never heard this concept talked and touched on. I don't know why, but I mean, it makes really good sense to me.
Yeah.
And I think I'm a pretty smart guy, but I'm like, that's actually pretty damn smart.
I hear that all the time. And that's what shocked me. Even at that high level mastermind group that I'm a part of with real estate investors, what shocked me is that very few had ever heard of the strategy, not even my strategy, because mine's more rare because I do that minimal cost, max ROI.
Yes.
But even the traditional.
Well, that's the caveat for me, that like for people like me, like, oh, well, that makes really good sense. But even for the most other people that were waiting 3 or 4 years just to get the cash value built up, then to do it, right?
Right.
So that's
and I use it. And I have even changed my strategy with it lately too. Like I now earmark a certain portion of it as my emergency reserves. Because I remember, February, my wife, she's like, I feel something's coming. She's like, I feel like we need to have more cash reserves sitting on the side. I'm like, well, how much? She said, well, I think we should have 200 grand just sitting in savings. I'm like, 200 grand sitting in savings. If we're earning 0.1% in our savings account, that's $200 a year of interest I'm earning on 200 grand.
Yeah.
I could do way better investing that. And I said,
go broke safely.
I was like, well, let's make a compromise here. And she was, by the way, a Dave Ramsey teacher. So she was all about buy term, invest the difference, right? I said, well, let's do this. Like, we've got cash inside of our life insurance account that she kind of just tried to ignore. She's like, I just don't understand it, Well, I said, let's keep 3/4 or 2/3 of that money sitting there, earmarked just for emergency reserves, because we can get to it in a week. Mm-hmm. Let that sit there. That's going to grow tax-free. Oh, by the way, this is another thing key for investors. In most states, it's 100% protected from lawsuits and creditors. So you could have millions of dollars in here. People cannot sue you and get to this.
Isn't that how OJ still has money?
Who knows? Maybe.
I actually think I read an article that the first thing his lawyers did was make sure that he took all his money and put it in some type of insurance product to make sure that he would always have money.
Yeah, because
I could be wrong, but I'm almost damn certain that's what he did.
I would not be surprised. Like that's a common strategy that a lot of wealthy already have been using, right? So
when you're guilty.
Yeah. But the cool thing is, like, now the reserves we have sitting aside, even though we now lowered it from 200,000, like 120, 150, now we got more money out, like, working the markets again. But, we're like, hey, at least we got a good chunk, 100 grand plus sitting here earning 4-5% plus
tax free. Tax free is the key word.
The rest of the money is sitting in the bank and we can get to quickly, that other third or quarter, right? And it's so even if you have money,
and then you still have death benefits and all the other things that go along with it. So just in case there's something to happen, someone's better off for it, right? Like, Chris, gets in a wreck tomorrow and is no longer with us. There's a death benefit, tax-free as well. Right. That's going to overexceed what the total cash value policy was anyways.
That's right.
So
you got it.
Dude, that's a huge strategy. How did you, where did you find that? What went on with, what event caused you to be like, oh, this is a good idea, and then you put your little tweak on it?
Well, like I said, I was the traditional financial advisor before, right? But I used to have people investing more in mutual fund type stuff. If they did life insurance, I would have them do it in the stock market, right?
Yeah.
And I remember, so when I met those guys in 2006, when I started going the real estate route, I quit being a financial advisor because I was like, those guys are broke. You guys are millionaires. I'm going to follow that path, right?
And by the way, that's a great story. We've had you on the show before. We talked about it. But I just want to, just for anybody it's been a while since I've had you on, just to retouch base to it. Like, that was your business. Like, you were a financial advisor. And I always say, it's the only place where, multi-millionaires will come in and take advice from someone making $100,000, $150,000.
Yeah.
And, but that's not real wealth. These guys are usually way more wealthier, have way bigger net worth. And that's what you were just saying is like, that's the game, right? It's like, I want to be wealthy. I want to be the guys that need the financial advisor.
Mm-hmm.
Right.
That's right. Because Yeah, I mean, the whole method of trying to save up your money over 40 years, and if you're only earning 6.5%, right? And then inflation's not 2 or 3% or 2% like they're saying lately, it's more like 4 or 5. You start to realize I'm never going to retire dumping money in these mutual funds. Like
Yeah.
mutual funds suck, right? Like
Yeah.
they're just high risk, mediocre returns. Like I would
And
much
high
rather
expenses.
high expenses. Yeah, you're paying for salespeople to sell this crap to you. Because really, dumbed down financial advising, there's nothing fancy about it. It's
I
mutual
felt like a
funds and
fraud,
insurance.
right? So, I mean, that's my background too. Is like, and I work for Edward Jones, and Edward Jones. I mean, they teach you
Yeah,
how to like sales. That's your job, is to sell front-loaded A shares, right?
yeah,
That's in mutual
yeah.
funds. Growth Fund of America was our flagship fund. Everybody
Mhm.
knew how to sell it, right?
Yeah,
74 years of history,
yeah,
and like they had this nice graph chart. And if you would have invested back in 1933,
yep.
here's what you would buy and hold. It was just buy
Here's what
and
you had
hold.
70 years later, right? And
Yeah. And,
exactly.
but that's not what happens, by the way.
No.
Because when those dips happen, people come to the office and say, sell it all. And then they wait till it to go up and they say, buy it all back. And they never get ahead. And that's why they're only making 6% or less.
Yeah.
And then it's fee. If you saw all the fees
Hmm.
that they really charge, it's kind of crazy, isn't it?
It is. And that's the thing is that you think about that model, right? I mean, the model, if you only do earn, say, 6.5 or maybe 7% a year, you do the math and you factor in inflation and taxes, you'll start to realize I gotta save a half or 100% of my income to retire on less than that income, right?
Yeah.
You don't really make anything.
You
And
start to figure out that you could probably do it better on your own. You're probably a little smarter if you were just like, why are you paying someone for this stupid advice when you
yeah,
could just go buy an ETF or
exactly.
or something on your own and not pay anything, right? And do the same damn thing.
And I'm even quoting an ETF, right? Yeah, yeah. I mean, you get the advisors; they usually don't even get the ETF returns, and
Yeah.
and it was a real estate investor that actually brought it to my attention. He used to be an advisor, and then he quit. He actually left my team to go quit and do real estate investing. And he asked me a great question. He said, "Chris, first off, how many of your clients are financially free?" And I was like, "Well, what do you mean? Like not worrying about money? Like I don't mean they're retired. I mean they don't worry about money.
Yep.
None." He's like, "Great job, Chris. All right, well, how many of you guys as financial advisors, because if anyone has this figured out, and I know some of the guys in your office have been doing this since the late 70s, mid to late 70s, they should be retired off of the investments, not the commissions, right?
Yep.
So how many of them are retired off of the investments they've been recommending, not the commissions?" I was like, "None." He's like, "That's my point." He's like, "That is the problem." And that's what got me out of that industry, right? And that's when I started getting introduced to new concepts, and I learned about that infinite banking. Nelson Nash is like the grandfather of it. He just passed away recently. He was like 90 years old. Like they all talk about it, but when they set it up for me, I remember I asked the guy that sold it to me, because I remember I knew about insurance a little bit, right?
Yeah.
And when he sold it to me, I said, "Can I overfund these? Can I put in more to accelerate the cash?" His answer was, "No. If you do, you'll lose your tax-free status." Well, when I hit the recession, right? I was out of the rat race in 2006. I was back in it in 2008 because I was gambling with my real estate and other stuff. So I'm back in the rat race. I'm like, I can't afford to pay this premium anymore. Because I couldn't afford to pay it, I lost that policy. Even though I put 25 plus grand in it, it was gone. It was like the most expensive, crappiest term policy you could have ever bought, right?
Yep. Mm-hmm.
And I was like, this sucks. And what happened is about within that year, I started like searching for answers.
Yep.
And I started talking to a few people and some other guys that were investors, and they're like, "Yeah, did you know you can overfund these?" I'm like, "Are you kidding me? You can?" They're like, "Yeah." And I started to see they could. And back then they only overfund like the costs were like 50% of your money in the first year, not 20, 50, right?
Yep.
And I was like, "That's huge. That's awesome.
Right.
That's amazing." And so I went back to that guy. I ran my own numbers because I'm insurance licensed. I ran my own numbers against his, with his, what they call straight premium whole life, right? Where it's high cost at the beginning, but then you make money down long term.
Yep.
It's like, well, you got to have the same death benefit because death benefit's important. I'm like, fine, I'll go play your death benefit game. Did that. I had more cash value and I still ended with about the same death benefit. The biggest difference is I would not have lost my policy during the recession because there would have been cash paying for itself by that point, by that third year. And I knocked down every argument he had. It was a 2-hour screaming match I had with this guy in his office.
Yep.
The people outside the office, the assistants were freaking out. They're kind of nervous, wondering what's going on.
Yeah.
And finally, when it came down to, after those 2 hours, it got down to one last objection. I was like, well, why would you do this knowing that everything I'm doing here matches all your reasons? He's like, Chris, I can't afford to cut my commissions that way. I was like,
bingo.
There is the answer.
You finally were truthful.
Exactly. He finally got down to the core of the truth. And that's what I'm finding. Even the guys that claim to be infinite bankers, they have this struggle because that's what they make their living off of, right? Like I'm making my living off my investments and stuff, off my residual and passive incomes, but they're making money off this. So there's always this struggle of, okay, well, I can give them a little bit, but maybe not the best, even if they know how to do the best, which very few do know how to structure it just right.
Yeah.
But even those few that do know, then they're like, well, yeah, but I cut my commissions back 75, 80%. Do I really want to do that? And so they might go in the middle. They might say, well, maybe I'll only cut it back, 67%, not 75 or 80, right?
Right.
And that's where I'll find people are like, oh, I got infinite banking policies. And then we look at him. I had one dentist, right? We looked at him and his wife's policies over the next 20 years. They're putting 150,000 a year into these, right?
Right.
Found out in the next 20 years, even though they've already paid their dues in these policies for the last 5 years or so, switching it and changing it over, they're going to make an extra $2 million more in the next 20 years, doing the same dollar for dollar comparison, apples to apples.
Wow.
And they'll have $4 million of death benefit more.
Wow.
So it's crazy.
No brainer, right?
Yeah. It becomes a no brainer if it's done right. But if it's done wrong, then it doesn't make sense.
Yeah. Well, that's the trick. So, because what you're getting at too, and this is what I know about you, is like you really offer people advice on what to do. It's not about you come at it as the holistic approach, right? Like, let me just figure out where you're at, what you want to do, and I'll give you some advice on what to do it, and even help you, like you're pro real estate and all that, investing in something outside the traditional stocks, bonds, mutual funds, like real assets with people. And this is the difference too, is that I found this to be really true, is when you're out there dealing with like real estate investors that go out and take people's money and use it to fund their deals. Yeah. Getting somebody that's way more qualified than, I would say, a financial advisor. A financial advisor passed the test, right? Yeah. But once they pass that test, most of them do not know anything about investing. Zero. And really making money grow. That's right. Right? They know how to make money as a salesperson, but they don't know how to make money investing. Yes, exactly. And so what you're saying is, listen, it's more important to have the relationship with people. And I think that's just kind of what you holistically do. And by the way, here's some other strategies that can make you money. Yeah. And set it up. And I think that is entirely different from the world that you came from, which was sell, make the brokerage money, keep the assets in the house, don't ever let it go, and make money at all costs. Because that's what the big firms are always doing. They do not care about you. They just want your money. Yep. And they train their salespeople to do exactly what works for them, not for the client. Yes. They've done such a good job marketing to make it believe it's for the client's benefit, haven't they? I mean, it's like, oh no, this compound interest, this putting away, don't look at the markets, don't follow the markets. In fact, just ignore it, turn your brain off, just let it do its thing, and it'll be there down the road. Don't worry. Yeah, that's BS. Like anybody who does that in real estate investing won't have money. You got to pay attention to all your baskets and all your eggs. Mm-hmm. Yeah, exactly. That was. I remember there was a time I met with a family member who came from a millionaire family. Right? They're self-made millionaires in business. They were owned auto dealerships and whatnot. And I remember he's saying, "Well, Chris, if I give you my money to play with, like $10,000, you're saying you might make me 12%, which is not true, but." I'm like, yeah, that's $1,200 a year, Chris. But I could take 10 grand, put in my business, and make at least another 20,000 of profit in a few months. So why would I invest my money with you? And I went right back to my repertoire of everything that they taught me to say, well, you should be diversified. Besides, business is risky. You should put all your eggs in that one basket. You need to have money in other places. Basically, whatever I sell, that's where you should put it. Yeah, the insurance says you need more insurance. I got all kinds of insurance you can buy. The stockbroker says you need to buy more stocks, right?
Exactly.
And what you really want is someone to say, I understand the whole thing, and here's the good idea of holistically, because he could be right, right? Yeah, but he also could say, hey, listen, everything's in here. Why not have a different something? But it's usually not stocks, bonds, mutual funds. It's usually way different. So, and that's good knowledge, man. Listen, if people want to get a hold of you and figure out all this great information, where can they find you at?
Yeah, first place to go to is moneyripples.com, MONEYRIPPLES.com, right? You can go there, you can check out my website, and you can contact me through there. Or you can even go follow my podcast.
What's your podcast?
Yeah, it's called The Chris Miles Money Show. In fact, the last time I was on a year and a half ago, a guy just reached out to me this week, said, hey, I've been following you ever since I heard you on Corey Peterson's podcast a year and a half ago, and I've been binging your podcast and his too. I'm like, sweet, well then go there too.
Yeah, so that's what I love about the podcast world. And really, man, for the people that they're listening, I mean, I try to bring really not just good guests, but great guests that I think have high integrity, high value, high content. Sure. And this is the second time we've had Chris on, because I think this, getting paid twice is a subject that I wanted to explore and just kind of understand it and really share that to the audience, because there's lots of ways to skin the cat. And we need to be practicing the way the wealthy invest, the way the rich people, what they really, really do, because they don't go to the stockbroker. They usually do this internally, or they have someone that totally takes care of them in that holistic approach. And really, that's what Chris is trying to be, like a family office to all the people that he talks to.
That's right.
And there's a difference in that. Family office don't just go buy stock. They may have some stocks, bonds, and mutual funds, but if it is, it'd be pretty small. They're really about making investments in businesses and people and processes, and that's truly how rich people play the game.
Yep, it's all about more of a consulting role versus that traditional salesperson role.
Yeah, salespeople never win, dude. Like that's the truth. Most of the times when you're sitting across someone that's selling stocks, bonds, mutual funds, you are not talking to an advisor. Okay, you are talking to a trained, and I'm saying Wudang Ninja level trained, like IP Man 4 trained, ninja salesperson.
That's right.
And dude, they're good. Damn, they're good. But it's not always beneficial to you.
Exactly. I totally agree.
Well, listen, guys, go check out Chris's podcast. Go check out his website. I think you'll find his stuff is truly very valuable, very good, very crisp information. And, let's kind of end it with this. And actually, last words. Any last words you want to give to the audience?
I'll just say this. Like, it's never about either or. And it's never an either or world. It's about an and world. How do we have both, right? Even the strategy we're talking about here, we still want you investing in real estate, because you cannot win without it, right? Or whatever it is that you do. It could be your business, but don't fall for the traditional crap that doesn't make you money. It's high risk. Go for the things you can control. Go for the things that are real assets. And that's exactly what Corey's talking about on his show too. It's like the real assets are the people that invest in those things are going to be the winners. Everybody that's investing in paper crap, there will be the losers.
Boom. Good job. Love it. Love it. Guys, thank you for taking the time to listen to this podcast. I truly believe wealth is created first in your mind. You have to start seeing yourself as a true entrepreneur, going out there, making a difference, strapping on all those, the people that are going to bring you what you need, right? It's really a team sport. Entrepreneurship and money making and wealth strategies is truly a team sport, but you've got to start with the idea in your mind, because if you believe it, you can achieve it, and your paradise is possible.